It's my pleasure to introduce Ayesha Tariq, a new guest, and Mayhem. Welcome to F.A.C.E, both of you guys. Great to have
Thank
you.
you so much, Dale. Thank you for having us on.
Okay.
Thanks for having us.
Great to have you guys. You know, I've been following your tweets. Congratulations on getting your views seen on Fox Business, Ayesha. So that's
Thank you.
And I was wondering, were you guys going to be sharing your screen and showing anything today, and do you want to stay off camera and just talk? It's up to you guys.
So I don't mind turning my camera on. That's
Okay.
fine. And
Okay.
I think,
I'll do it too.
Yeah.
There. Nice to meet you.
Great. It's nice to see you.
And Mr. Anonymous Mayhem, I know he's going to keep his face here today.
Well, good for him.
All right.
He doesn't have to put on makeup.
All right. So, you know, before we get to the markets and what you do, it's always interesting to hear about people's origins and their journey and how they ended up in the industry. Ayesha, you want to just tell me, I know that, you know, probably when you were in high school, you weren't dreaming to be doing something like this, or were you?
Not at all, actually.
Okay.
You're absolutely right. No, in high school, I wanted to be in advertising and I wanted to be in marketing. So that was something that I was very, interested in. And in fact, that's what I studied even in college. I never studied finance. But then there was this great opportunity with an international bank called Standard Chartered. I'm sure you've heard of it. Yeah.
Yes.
And so I joined their, graduate program, and the rest is history. And I became a corporate banker after that. I spent the next 12, 13 years of my life in corporate banking. Thereafter, I moved into asset management. I was the head of treasury for a local group here in the UAE. I live in Dubai right now.
Okay.
And so that was a very interesting role because we had a sizable portfolio, about 300 million in listed equities, and about 700 million in hard assets, hotels and real estate. So quite an interesting mix of portfolio. We were, raising debt and at the same time equity as well. We were investing in businesses. So it was a very interesting role. I did that for about a little over 2 years, and then I left to start my own consulting company, financial consulting, helping smaller businesses, medium-sized businesses raise equity, raise debt. And thereafter, I got, more focused on the markets, particularly during the pandemic. We didn't have, many deals around. Going out was difficult. So what do? You work from home. And so I started, looking more and more at the markets. It was a lot of what I did in my corporate banking life, studying companies, looking at, what's good, what's bad, what to invest in. And so thereafter I joined Mayhem and the team at Trader 8. And so now we have an educational platform where we try to educate retail traders on the markets, on macro, fundamentals, and trading.
Okay. So Mayhem, you probably had to find something different when they gave your role on TV to Mayhem that promotes, I believe, auto insurance. And you had to go to the markets. Have you seen that guy on TV?
Yeah, no, he's great. And I remember seeing him from Oz originally, and he's actually quite a good actor as well.
Okay. So your journey, buddy.
Yeah, so I grew up in a household where my father was very into investing in the stock markets. There was always CNBC or other financial media on TV. There was always an Investor's Business Daily or Wall Street Journal on the dining room table. And so I found myself immersed from a young age in markets. And when I started to make some money, I wanted to play around a bit in the markets when I was younger. So I asked to put on 2 trades. I borrowed a little money from my dad. I put some of my own money forward, and I bought some Yahoo and some Amazon back in the .com boom, and they both doubled in about a day, and that quite frankly terrified me. because that's just not how things are supposed to work. And the first thing that I kind of thought about was, well, if this is how markets work, no one would work. No one would have a job. You'd just put money into Yahoo and Amazon and cash it out and you'd be set. So I
Well,
said, take all
that's
my,
what happened. That's what happened during the pandemic.
yeah.
And they
We can
haven't
see how
gone
well
back
that
to
went.
work. Yeah.
Right. But we
Oh,
can see how
that's
well
right.
that's worked for all the people that held on to those bubble stocks. Right.
Yeah.
So,
And yeah.
so I got out of that and I just kind of wanted to learn more about how this would even be possible. And I watched the dot-com bubble bust and sort of the chaos unfold. But one of the things I noticed back then was that no matter where you are and who you talk to, and even me at a young age, I could hop in a cab and the cab driver would be talking about the stock market. And I just felt like that was very unusual. So I saw that all play out. And then I said, I'll learn more about the markets. I'll get back in when I have some more money and some more knowledge. And so I got into, doing consulting. I've been in technology for quite a long time, and I started making money and, investing it and trading it in 2005. And I did pretty well. And then I got to 2007 and I had some good long-term capital gains. And I saw the market kind of put in what looked like a longer-term double top in the later part of 2007. So I said, look, I'm seeing some weird things out there. I had bought a home not long ago, and I noticed that when I refinanced, that they basically gave me a no income, no documentation loan that I could just walk in there with a
Liar's loan.
pulse. Yeah, I could basically walk in there with a pulse and buy 3 houses. And it was just incredibly disconcerting. So, as we got into the fall of 2007, I said, I think I'm just going to take my chips off the table. If we break above these all-time highs, I'll get back in because that'll show me that there is conviction that buyers can take control from here. But if they don't, I'll just step aside. I'll take my long-term capital gains. I'll pay taxes on it and I'll sit and wait. And so I did. And I had no idea what all was going to unfold. All I knew is what I was hearing in the news about money markets seizing up in the August of 2007, the Fed continuing to push on rate hikes. And I just felt like the backdrop wasn't very good. And then the great financial crisis unfolded in front of me, and it gave me an opportunity to learn a lot more about the plumbing of financial markets, the economy, and sort of the value of understanding this and how it could really impact price discovery. And so from there, I traded throughout the great financial crisis. I woke up on some days where the Dow was limit down and the Fed would come in and intervene with a 50 bips cut. It would be sort of a stick save for a lower high, and then we'd plunge to new depths. And it was pretty fascinating, and that had me enthralled. So I started to get more into trying to do more in the financial industry. And in the years ahead, I started doing consulting, taking my acumen from tech and advising institutions and investment managers on what I saw in technology and trends and which companies made sense to consider investing in and which ones were best to be avoided. And that's kind of how I got my start. And since then, I've been actively trading and investing and co-founded TraderAid in January of 2022 with my buddy Horse. And then Ayesha joined the team just this summer. And the three of us have been growing the company and having a lot of fun and educating a lot of folks. So it's been a great journey.
I like the pairing of 3. 3 is a powerful number to me. It's a number of completion. And I also believe in, 1 + 1 + 1 equals 111, not 3.
There we go.
If it's symbiotic, it can be powerful. So let's move to what's top of mind in the markets. And, I want to start with Ayesha. It's my belief that the dollar is the fulcrum of the wheel, that all other asset classes revolve or spin around them. And, in a couple of months, we've had a very big hit to the dollar when no one was expecting it. And now it's starting to get a bit crowded. What's your view on the Dixie? And do you believe that this is the beginning of a major bear market? And is it a little bit too much too fast and nothing goes straight up or down, right, Mayhem? Could we be near an inflection point for a bear market rally in the dollar?
Actually, yes, I think so. I actually had some slides prepared about, earnings season because fundamentals is what I do. But it was more of a long-term view on, how earnings season will probably play out and set the stage for 2023. So if you talk about immediate term trends, I think it's either or. So you could have the S&P driving the dollar or the dollar driving the S&P, right?
Yeah,
So
it's all one market nowadays for a year or two, isn't it?
It
You know,
is.
the only difference is magnitude and size of the moves.
Absolutely. So I think earnings season is going to play quite an interesting role this time. And if I may, I'd like to share some of my slides, if that's
Yeah,
okay.
that's great. So I stopped sharing, and all you have to do is go to the bottom of the screen. I'm sure you guys have been on Zoom before. See it? Little green button says share screen.
Yes.
There, here it comes. Okay, got it.
Great. Okay, so basically, what I wanted to look at, as I said, is a little bit about this earnings season, and then how we're looking at it, in the broader context of things. So where will 2023 kind of take us? I know it's a little premature, making estimates at the beginning of the year, but I think we've seen enough of the macro picture and we've seen enough of what's happening. And the Fed's been very clear about, their message and where they want to take things. So I think we can make some reasonable assumptions, let's say, as to what we would probably see in the S&P, or where the S&P would be by the end of the year. So starting off with earnings season for this quarter, this is the first quarter we're actually projecting a negative growth in earnings. So technically we're entering an earnings recession this time. And I do think that this number of, let's say around 4% is actually quite low. I do think we will see a slightly, further decline in earnings. Now, the one thing you can see obviously on on the left is that energy has actually propelled earnings, and they've held
Yes,
it up quite well for almost
all
all of
last year.
2020. Yes,
Yeah.
absolutely. So I
Mhm.
think a lot of that will continue to feed into earnings for the last quarter as well. The other thing about energy is, even though people have seen a pullback in oil, and technically, yes, going from $100 to $70 is a pullback, but in the greater context of things, $70 is still pretty expensive. And the rate of change has come down quite a bit. It's declined drastically. So we think that, we're feeling a lot of relief when we look at the CPI, when we look at, gasoline prices, when we look at diesel prices. But in general, it's still quite high. The average of, the average price of energy in the last 10 years has been less than $70 a barrel. So we're still looking at 75, even a $5 increase from that $70 mark actually feeds into the system and pushes things up quite a bit. So that's something to remember.
So
Now,
inflation continuing to be sticky, and a premature call of victory on inflation, which happened several times in the 70s, where they thought inflation had peaked and the Fed had to come back in and start a tightening campaign again. That's what you see on the horizon here.
absolutely. I do think that we will see a few things go up here and there. So we talked about energy and how it's come down quite a bit. But again, you and I both know the price is really volatile, and it won't take very much for it to go up again. And we're seeing things happening in the market, right, that might drive the price of energy up. And even a temporary increase to say, let's say $85 or $90 a barrel is enough to, shake that number where energy costs are concerned, because they feed into it pretty quickly. They feed into
Have
the
you ever
CPI
seen
numbers.
a year where you could get a move in WTI from 130 or 120 to 70, and the oil shares continue to show leadership? They look like they're completely unrelated industries, that the underlying commodity was in a bear market while energy stocks held up the market. Have you ever seen that before? How about
Actually,
you,
not
Mayhem?
like this, not like this.
Yeah, I've never have either. It was kind of amazing to me. You look for a continuation of that, because most strategists are still very constructive on oil shares, the energy complex.
Yes, and the reason is, I think people do understand that what we faced in the last 2 years is, uh, we don't have enough energy resources. And they've come to realize this in the last 2 years. So I think there still is a lot of investment going into or let's say there's a renewed interest in investments where energy is concerned. And I'm talking about oil companies. So this is why I think part of that is what's driving the price of the energy stocks. And obviously money flowing into that is going to lead to, further investments and, better returns. The other thing is what we started with. So this is a nice chart that shows, what people are, what the negative issues are facing companies this quarter. And the first one is exactly what you spoke about, the dollar, right? So the strength of the dollar has really hit earnings in the last quarter. So the third quarter, let's say, that's when the dollar was very, very strong. And while it has pulled back significantly in the last 2 months, I would still say it's pretty strong compared to where it should be or where we've historically seen it to be, right?
Okay.
And I think this still flows through to earnings. And I do believe that we're going to see that, come into play as well this quarter. The other thing, which will also affect CPI to a large extent, is wage and labor costs. So that's basically the second biggest issue that companies are facing right now. So they're still seeing wages go up and having to pay workers more, and that obviously takes money out of earnings for them.
The Great Resignation is a secular shift in labor supply, along with the demographics also not being supportive of more labor, and people aren't coming back to work.
Absolutely. And I think some of that will remain sticky. Some people will probably never come back to work, and they'll choose to work from home or start their own thing, however it might be. But I mean, look at us. It's so
Right.
easy now for us to be able to do business, and not just in a country, but all around the world. And all of these technological advances, I think, has helped. And you're right, there is going to be a secular shift versus, something that's just very short-lived.
Okay, and that's what the Fed is very focused on, to be able to, what they say, get their job done. They have to create an employment recession in the face of a smaller supply pool of labor.
I mean, so the issue is, I think it's a bit of a chicken and egg situation, whether they want to create the employment or unemployment situation, or the unemployment situation gets created. But either way, one will be driving the other, right? So, and that's something that unfortunately we will probably need to see if we want to see, inflation come down meaningfully now. And we would need for the supply and demand to be more in balance. So speaking of the dollar again, this is like another slide which I wanted to kind of show, because it shows, companies that have over 50% of their revenues coming from outside the US are expected to, yield a much worse number in terms of earnings. Whereas the companies who don't have as much, they see their earnings go down by only minus 1.8%, which is not quite it's a stark difference. So this makes it very clear that the dollar is playing a huge role. The strength of the dollar is playing a huge role when it comes to beating earnings down. So I think that's something that will still continue to play out even in quarter four. And speaking of the dollar gaining strength again, I do think in this quarter we see it start to gain strength again, which will then affect next quarter's earnings. So
interesting. Okay.
I think this year we still see the dollar have quite a lot of an effect on earnings in general,
let alone egg prices. Okay, so right, I mean, the Fed can't control food prices. It's all Mother Nature, right?
So in a sense, yes, it is all Mother Nature, but also in a different way. Again, it's a little bit of a chicken and egg situation. As inflation started to go up, I mean, forgive my pun, but as prices started to go up, companies had to raise prices, retail prices as well to cover the input prices. And so it's sort of, piles on. And so now the situation that we're probably going to see is that we'll still see some prices, particularly for staples, still remain high, whereas input
Yes.
costs are coming down, which is one thing that I discussed even on Fox, that's why I think, consumer staples will tend to do slightly better, because you'll see input prices coming down, but the revenue levels still staying quite, relatively high. So you'll have more margin and therefore more profitability and, better performance. But
And
one
what's the
concern that sorry.
Oh, no, that's okay. The meaning and what you're getting from this monthly inventories chart that we're looking at.
Yeah. So the one thing that we saw in the last couple of months is a lot of complaint around inventory buildup, and how companies were saying that they had too much inventory because they had ordered too much, and then demand started to slow, and obviously people didn't want to buy discretionary items anymore. They were more, they were spending more of their money on food and basic products. So a lot of this inventory piled up. So while a lot of them did get rid of their inventory to a large extent, especially during, let's say, the holidays, by discounting and all of that, and that in itself will also hit earnings. But what we see is the inventory levels are still quite high, much higher than they should be. And so I do think that we are going to see a few more quarters of, discounting and, bringing prices down significantly, which in one way will help, the CPI numbers, but at the same time, it's going to hurt the companies, particularly discretionary companies, who are making goods and services that are not basic products. So
Okay.
we see a disconnect over here also a little bit.
So let's say, do you feel that these things are not priced into the market, and that the October lows, based upon these fundamentals, will be threatened sometime in the first quarter?
So some of it obviously has been priced into the market, and I do think people have caught on quite a lot more than what we saw in October, for example. And the reason is we're finally, coming to grips with the fact that we are in a bear market, and we know that earnings are going to come down. I think the market is recognizing these issues a little bit more as we go on. So I do believe some of it is priced in, but there's always room for surprise, right? And so, for example, this chart shows us that, so the gold line is basically, price dispersion of the top 5% of the S&P. So you can see that the big boys are actually pulling earnings up, right? Versus, the smaller companies. I think this is something that's going to change, because what we see in a bear market, and I know you all know this much better than I do. I've only lived through 2008. But basically, it's the smaller companies that go first, and then it's the bigger companies that
Then the
start to fall.
generals. First the
Yes,
troops, then the generals.
exactly.
Yeah, I want to bring Mayhem into this, and I saw a chart that you tweeted, Mayhem, if you're still with us. I
I'm here.
believe it was it money supply? And you showed this very huge decline of liquidity, and people are saying that financial conditions are easing right now, and the chart that you showed definitely shows a different picture of financial conditions. You want to elaborate on that?
Sure. Well, I think there are two different areas too. So money supply is really, what we're seeing is the growth of money supply is having a very steep contraction, right? We're actually starting to see a decline in money supply. It's going to take some time for that to really affect financial conditions, which in Fed speak is really just, hey, how expensive are bonds and stocks? And from the Fed's perspective, and it's a little more nuanced than that, but that's the big takeaway for traders and investors. The Fed's saying that they're too expensive, that they need to come down further. And in fact, we've had a pretty significant loosening in financial conditions from the tightness we saw in October, where that low was put in on that lucky October 13th CPI day, where we had that very violent reversal. Right.
Yes.
So I think we still have financial conditions as evidenced by an S&P approaching 4,000 in the cash index and by bond yields seeming to have dropped, the dollar continuing to drop. None of this is doing the Fed any favors. Powell has, of course, spoken about the idea that these wealth effects have manifested earlier and earlier retirement, going back to what you all are talking about with the labor force. That's one of the reasons there's not enough participation. And so one way to get people back into the labor force is to make it so that early retirees sadly can't retire.
Yeah, by taking down the value of their 401ks and retirement plans.
And real estate too.
On. And
yeah.
and a potential pension crisis. Biden had to boost a Teamster pension. That could be something looming on the horizon. So, this has been an outstanding interview, and I could talk to you guys for about, I don't know, a day. But what I'd like is best idea, it's halfway through January, what you feel is going to be the best way for people to consider everything that you guys have talked about. Should people be more interested in the return of capital than the return on capital? And is this rally that we're seeing in the precious metals, does it have legs? And what's your preferred intermediate call, your best call intermediate term, say into the beginning of spring?
Sure.
Mayhem?
Yeah, sure. So, I mean, I think that we are seeing some relative strength in materials, in metals and mining, particularly in industrials versus the broader market. So those are areas that I would continue to focus on. I also think it's interesting, speaking of agriculture, to look at soybeans. They seem to be putting in a low and starting to rally off that low.
Yeah.
And I also
Beans
like
in the teens used to be the war chant on the board. Now we
Very
have
good.
to come up with something that rhymes with 20.
Yeah, I think well, we don't have copper aplenty, so maybe that rhymes with 20, and that's something to look at from a production and supply deficit standpoint as China comes online.
Okay, I appreciate that. Ayesha, your advice for people with what you're presenting with the potential earnings recession that you don't feel is priced in, is this a time to be, more in cash?
So I would say that yes, I think taking it one step at a time would be very important, right? For me, I still like the defensive sector. So I like consumer staples, I like utilities, and I do like a few choice industrials, the stronger ones, because industrials still tend to do quite well when the Fed is raising rates. Interestingly enough, even though they're capital intensive companies, they still tend to do quite well. So I think we've seen some strong leaders in, say, Caterpillar and Deere. Yeah. Now these have run up quite a lot, but I think a lot. But I do still see strength in these if, we can wait for a pullback. We might see some pullbacks during earnings because we might hear some surprises. So I think earnings is a good time for us to wait for, let's say, pullbacks into stocks that have been strong and will continue to be strong, at least until, let's say, the end of spring.
Okay. All right. Well, a great interview. And you guys now, Ayesha, you're my trading warrior sister, and Mayhem, trading warrior brother. Really appreciate you guys coming in on a holiday and edifying the F.A.C.E community. Glad that our paths crossed, and I'm rooting for you guys in Trader Aid. And the best way to find you guys, of course, on Twitter, you could find Ayesha at Ayesha Tariq, and you could find Mayhem at Mayhem for Markets. What an appropriate title for that guy. Thank you, Mayhem.
Thank you. Appreciate
Thank
you
you,
having
Dave.
us.
Appreciate it. Great. I'm glad our paths crossed. Hope to be able to have conversations with both of you guys down the road.
Thank you. Thank you for
All
having
right.
us on. Take care.
You're very welcome.
Thanks
Remember,
again.
don't just count your pips, count your blessings. You could join the team in 12 minutes. Thank you, everyone. Enjoy the holiday.
Thank you.
Adios.
Bye-bye.
Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.